everyone. Hope you are doing great. Today, I'm going to discuss how you can formulate a news trading strategy. Major economic events and fundamental developments are closely watched by currency traders as they reflect the strength of a given economy and may indicate direction of a given currency. Trading the news is often difficult and may not be suitable to everyone, but the volatility that follows can generate a trading opportunity for everyone. Next, choosing events that produce volatility. Before developing a trade, the news strategy, market participants should familiarize themselves with the key event risks that heavily impact the major currencies. During normal market conditions, shift in government policy, changes in central bank policy, and economic development tends to drive price action. So, being able to identify the key event risks can help avoid being on the wrong side of the market. The economic calendar highlights the fundamental developments coming out of the economies with the most popular traded currencies, and the number of events can range anywhere from 100 to 200 for any given week. So, for the identifying the risks, event can help avoid being on the wrong side of the market. Indeed, it may be a cumbersome task to filter through the slew of data. Next, pick currency pair that fit the trade. After identifying the events to watch, we usually want to trade the currency linked to that event's economy. Yet, currency trading is buying or selling one currency against another. We likewise have to pick the counter currency. Choosing the appropriate currency pair is another crucial practice of trading the news. Next, basic concept and trading tips. There are different strategies that comes to mind when trading the news events. However, finding the style that fits one's trading personality and tailoring it to meet different market conditions can help to curb the risk for loss while broadening the scope to benefit from market volatility. Some strategies involve setting up entry orders ahead of the event risks, while others are dependent on mathematical calculations, but all require some degree of prudence and flexibility given the inconsistency in the market reaction. So, every time you will notice different reaction than the earlier one as conditions and sentiments of the pupil keeps changing. At times, the best move is to stand aside when traders show a muted reaction to the news or when the market turns choppy. So, there is no single strategy to trading the news events. When the news crosses the wires, there tends to be either a sharp spike in a one direction or a mixed reaction to the data as traders digest the outcome against the market expectations. So, strategies involve setting up entry orders ahead of the event risks, while others are dependent on mathematical calculations, but all require some degree of prudence and flexibility given the inconsistency in market reaction. When the new crosses the wires, there tends to be either a sharp spike in a one direction or a mixed reaction to the data as traders digest the outcome against market expectations. More times than not, it will be difficult to discern whether the initial reaction will continue to gather pace as global investors weigh the implications of the data. Often, the best thing to do when in doubt is to wait for confirmation in order to avoid ending up on the wrong side of the market. Letting the noise clear should help currency traders get a better sense of where prices are headed. Next, here are some guidelines that involve some of the best practices. First, trade based on the outcome versus expectations, not versus the prior number. That is, forecast versus actual. Watch the initial reaction for direction. Next, wait for follow through the confirmation. Beyond that, looking at the reaction in smaller time frame can provide a clearer signal of whether or not to trade the event. Depending on your level of comfort, time frames ranging from 5 to 15 minutes can help identify the strength behind the initial reaction, while using the closing price of a short term candle as confirmation can assist currency traders to catch the market reaction before it gets exhausted. As most news events tends to have a limited impact on a longer term price action, setting realistic targets and stops should help to increase the number of winning trades. And at the same time, traders should implement a high degree of prudence when using leverage as market reactions following news events tends to be inconsistent. I will show you the reaction of a market after NFP releases in a different month. NFP releases in the month of February. NFP data was like first NFP is released on first Friday of every month. So now we are discussing about NFP releases in the month of February. The US economy added 49,000 jobs in January of 2021 compared to market expectations of a 50,000 rise. So, it follows a shuddering halt in December as COVID-19 restrictions on our businesses started to ease last month due to a lower number of new infections and hospitalizations and the speed up in vaccination. In January, notable job gains in professional and business services and in both public and private education were offset by losses in leisure and hospitality, in retail trade, in healthcare, and in transportation and in warehousing. So, in December, as the COVID-19 restrictions, business started to ease from the last month due to the lower number of new infections and hospitalizations. Unemployment rate had dropped as compared to the January to February. The US unemployment rate dropped to 6.3% in January 2021, down zero point 0.4 percentage point from the previous month, end well below market expectations of 6.7% as the number of unemployment person decreased to 10.1 million. So unemployment rate was dropped as compared to the previous month and market expectations of 6.7% and the number of unemployment person is decreased to 10.1 million. Next, now have a look of USD JPY 5-minute chart. I have highlighted it in eclipse. USD JPY slide to lower side by more than 20 pips. Next, now take a look at hourly chart. You can see inconclusive reaction in that hour. It has closed near the opening value after moving high and low by almost 30 pips. As we can see, it had then kept sliding lower that day. Now, we will look at a picture on a daily chart. It has just started an uptrend in the month of January. Notice the red bar on a daily chart, which I have highlighted in the eclipse. After the release, it went into correction mode for few days and then continue its uptrend again. So in a 1 day chart, it released into the correction mode for few days and continue to uptrend. Next, now let's check out the reaction of NFP release in the USD JPY in the month of March. NFP data was like the US economy added 379,000 jobs in February, way before forecast of 182,000, and the unemployment rate edged down to 6.2% from 6.3%, suggesting the labor market recovery gained traction. So, meanwhile, the yield on the benchmark 10-year Treasury note jumped to 1.61% right after the payroll release before retreating to 1.59%. Now, have a look of USD JPY March releases. First, take a look at a 5-minute chart. USD JPY was in uptrend before the release. After the release, USD by JPY jumped higher. It was a move of nearly 30 pips to the higher side. After that, it paired all its gain and kept consolidating on Friday. Next, now have a look at a hourly chart. On Monday, you can see it has started in moving to higher side in the uptrend. Next, now take a look at a daily chart. On daily chart, you can come to conclusion as in the month of February data was not that much impressive as USD JPY went into correction mode. But in the month of the March, USD JPY continued its uptrend as NFP data was much better than expectation. So basically, USD JPY data In the month of February was lower than March, and in the March data was better than expectations and better than February data. And March NFP releases are much impressive than February. So, friends, this will help you to analyze any economic data in the future. Hope you enjoyed the content. See you in the next video. Thank you for watching. Bye bye. Take care.